Okay, let's unpack this. Welcome back to the deep dive. Our mission today is a really rigorous, targeted deep dive into the 2025 tax credit updates. We're talking about the specific numbers, the rules that are going to define the returns you file next year.
Right. And we're really aiming to cut through all the complexity here.
Exactly. We want to hand you the figures that directly impact your family's finances, focusing on dependents, work, and education.
And this goes beyond just listing the facts. I mean, for anyone serious about financial planning, understanding the architecture of these credits, how they phase out, and the crucial difference between refundable and non-refundable. That's the key.
That's the shortcut.
It is. And the big story this year is really one of certainty. Things are becoming permanent.
And that certainty is power, right? So let's establish the theme. We're zeroing in on the increased child tax credit, the newly permanent income phase-outs from OBBBA, and the inflation-adjusted figures for things like the earned income credit.
Precisely. We're looking at a system that's finally settling down.
Which means you can actually start thinking in like 2 or 3 year cycles instead of just scrambling every single year.
Exactly. When the legislation sets these high income thresholds and then makes them permanent, that changes the whole game. It lets taxpayers who kind of hover around those lines use planning strategies that were just impossible before.
Okay, so let's start digging into those details. The foundation for millions of families. The child tax credit, the CTC. For 2025, it saw a pretty critical increase, hitting $2,200 per qualifying child.
Correct. That's $2,200 per child under age 17 at the end of the year.
Yeah.
But, just knowing that total number isn't really enough.
No.
The strategic insight here is really in its two-part refundability structure.
Okay, let's dedicate some time to that refundability breakdown because this is where the money is, especially for, lower to moderate income workers.
Certainly. So out of that $2,200, up to $1,700 is the refundable part.
The ACTC.
That's the additional child tax credit, or ACTC. And when we say refundable, we mean it literally. You can get that money back as a refund, even if your tax liability is zero.
So it's a massive income booster for the families who need it most. So what about the other $500?
That part is non-refundable. It can reduce what you owe all the way down to zero, but it won't give you any more money back after that.
Got it.
Now, to get the full refundable benefit, that full $1,700, there's a mechanism that's really designed to link the benefit directly to working.
And that's the 15% rule, right? How does that work in practice?
It's calculated as 15% of your earned income over a $2,500 floor up to that $1,700 limit.
Okay.
So this mechanism is crucial. For example, if a family only earns, say, $10,000, 15% of the $7,500 they earned above that floor is only $11,125.
So they don't hit the full refundable amount.
They don't. It ensures that the biggest benefit really goes to those who are actively earning.
So at the end of the day, the government's making sure this tax benefit is tied directly to participating in the workforce.
Okay, let's pivot to the other end of the spectrum, the phase-outs. The fact that these are now permanent under OBBA, that's a monumental change.
It truly is. For 2025, the thresholds start pretty high. $400,000 in modified adjusted gross income or MGI for married filing jointly.
And $200,000 for single filers.
And head of household, yes.
Wait, $400,000? That's still a pretty high earner threshold. Does that mean for most middle-class families, this phase-out is almost a non-issue?
For most, yes. It's irrelevant. But for that small percentage who do hit that line, and more importantly, those who hover near it, the permanence is a gift. You now know, year after year, that this is your strategic leverage point.
And what's the reduction rate once you cross that point?
They shave $50 off the total credit for every $1,000.
$50.
Or even a fraction of $1,000, that your MGI is over the threshold. Okay, let's use our example. Elena and Javier, married filing jointly, 2 kids. That gives them a potential CTC of $4,400. Let's say their MGI is projected to be $425,000.
Okay, so they're $25,000 over the $400,000 threshold.
Right.
Applying that rule means $50 times 25. That's a reduction of $1,250. So their final CTC drops to $3,150.
So here's the planning lesson then. If Elena and Javier see they're going to hit $425K and they have some control, say, they could contribute more to a traditional 401k instead of a Roth.
Well, the smart move is often to do exactly that. Maximize those traditional retirement contributions. Find other deductions to lower their MVGI.
Because if they drop it just below $400K.
They say that full $1,250 in credit reduction, plus the tax savings on deferring that income. The permanent threshold just makes that kind of planning actually worth the effort now.
That makes perfect sense. Now, quick question on identification. It's still no SSN, no CTC, right?
Absolutely. To claim the full credit, including the refundable ACTC part, the qualifying child must have a valid Social Security number. No exceptions.
But if a child is, say, too old or maybe uses an ITIN instead of an SSN, there's still a fallback. The $500 credit for other dependents, the ODC.
That's the safety net. The ODC is a non-refundable $500 credit for dependents who don't qualify for the CTC. Think college kids, 17 or older, or elderly relatives you support.
And the ID requirements are more flexible there.
Much more. An SSN, an ITN, or an 18 is fine for that dependent.
So our example, Carlos, he's claiming his 20-year-old niece and his 68-year-old aunt. Neither is eligible for the CTC.
So he nets $1,000 in non-refundable ODC, a crucial $500 per person that a lot of people just overlook.
Right, especially with college students, that $500 is still on the table.
It is, provided he's below those income phase-outs we just discussed.
Okay, so we've just seen how the CTC is tied to work. Let's look now at the cornerstone credit for incentivizing work, the Earned Income Credit, or EIC.
The EIC is it's foundational, it benefits millions of working people, and crucially, it's fully refundable.
Yeah.
The 2025 amounts have all been adjusted for inflation.
And this is where we see the most drastic difference based on family size, right?
That's absolutely true. The numbers are stark. For a family with 3 or more children, the maximum credit hits $8,046. $8,000! What? For someone with 0 children, the maximum is a much more modest $649. And there's still the requirement that investment income can't be more than $11,950.
That large maximum EIC, over $8,000, that can be the difference between struggling and stability for a family. It's one of the most powerful tools in the code.
It absolutely is.
Yeah.
And the phase-out range reflects that. For a married couple with 3 or more kids, they don't lose the credit completely until their income hits $68,675.
Okay, and for a childless couple?
For a childless married couple, they're phased out at just $26,214. The disparity is completely purposeful.
So let's put a face to this. Leela, single, 1 child, $25,000 in earned income.
Okay, so her income puts her squarely in what we call the plateau region for a single filer with 1 kid. That means she gets the full refundable credit,
Which is?
$4,328. And because it's fully refundable, that amount is guaranteed to her, regardless of her tax liability. It's a direct financial boost.
Let's move to another key credit tied to working, the Child Independent Care Credit. This is to help with the costs of care so you can work.
Right. The basic rules are stable for 2025. You can count up to $3,000 in expenses for 1 person or $6,000 for 2 or more.
But this one is non-refundable.
It is non-refundable, and its value is on a sliding scale that's tied to your adjusted gross income, your AGI.
So it's not a fixed amount, it's a percentage of your expenses.
Precisely. The highest rate, 35%, is for taxpayers with an AGI of $15,000 or less, and then that percentage slides down until it hits the floor, a minimum of 20%, once your AGI is over $43,000.
Okay, let's see that in action. Priya is single, 2 kids, AGI of $32,000. She spent $7,500 on after-school care.
Okay, so first, her eligible expenses are capped at $6,000.
Right.
Her AGI of $32,000 puts her in the middle of that scale, so she qualifies for the 25% rate.
So 25% of $6,000, that's a $1,500 credit.
Exactly. It reduces her tax bill, but again, it won't give her a refund.
Now, speaking of planning, I saw in the OBBA provisions that the maximum percentage for this credit is set to jump to 50% in 2026.
Yes, that's a really important signal.
Why delay such a big increase?
It's likely a budgetary measure, but from a strategic view, it shows lawmakers know how big the burden of care is. They intend to make this credit much more powerful. For taxpayers, knowing that 50% cap is coming is vital for planning. It affects decisions you make today about big elective care costs.
That's a perfect segue into our final segment, investing in the future, education, and adoption. Starting with college, people always confuse the American Opportunity Tax Credit, the AOTC, and the Lifetime Learning Credit, the LLC.
The easiest way to think about it is this. AOTC is the powerhouse for the first 4 years of college. It's undergrad only.
And you have to be enrolled at least half-time.
Right. The LLC is the flexible catch-all. No year limits, no enrollment limits. It's perfect for grad school or just taking 1 course to get a new skill.
And the dollar difference is huge. AOTC maxes out at $2,500, and a portion of it is refundable.
It is. It's 40% refundable up to $1,000. That's a major distinction. The LLC is totally non-refundable, and it maxes out at $2,000.
And you have to choose one or the other for a student.
You do, which makes the AOTC's refundability a massive strategic advantage in those early years.
But they share the exact same income phase-outs for 2025.
They do. For a single filer, it phases out between $80,000 and $90,000 in Uniper High.
And for married filing jointly.
$160,000 to $180,000.
So our example, Aisha, illustrates this. She's MFJ, MAGI of 165. She's claiming the AOTC for her son and the LLC for her own grad school courses.
So because 165 is exactly halfway through that phase-out range, both of her credits get cut by 50%.
So her son's potential $2,500 AOTC gets cut to $1,250.
And her potential LLC gets cut in half, too.
Okay, wait. The sources say her LLC is only $400 after the reduction. Why not $1,000 if the max is $2,000?
Ah, great catch. That's where the detail matters. The LLC is 20% of up to $10,000 in expenses. So if her expenses were only, say, $4,000, her full credit would have been $800 to start with.
Whoa, okay.
And then if that $800 is reduced by 50% from the phase-out, she's left with $400. It's a great example of how you have to know your rate and your phase-out at the same time.
That really shows the layered complexity. Okay, finally, let's wrap with the adoption credit, which saw what you called a game-changer update.
It absolutely did. The maximum amount is huge, $17,280 per child.
But the massive update under OBBA is that it's now partially refundable.
Yes, up to $5,000.
And that $5,000 is so critical. Before, a lower-income family might adopt, but they might only owe, say, $2,000 in taxes. They couldn't use the rest of that huge credit.
Exactly. The benefit was often wasted because they didn't have enough tax liability. This removes that barrier. Now, that $5,000 is available as a refund no matter what you owe.
So the relief is actually accessible to the families who often need it most.
It is. The non-refundable part is still capped by your liability, but this opens the door dramatically.
And for those tracking, its phase-out is independent, starting at about $259,000 MGI and disappearing at $299,000.
Another one of those fixed thresholds that really enables long-term planning.
So what's the bottom line as we close out our deep dive? We've seen the CTC increase to 2,200, the EIC numbers adjust up, and these really critical steps toward refundability in the ACTC and adoption credit.
The overarching theme, the big strategic takeaway, is the permanence of these phase-outs. You now have certainty. Knowledge of these fixed income lines is power for planning, whether you're trying to maximize the CTC or stay under the adoption credit phase-out.
And as a final takeaway reminder, always understand the difference between refundable and non-refundable. Refundable, like that $1,700 part of the ACTC, means money in your pocket.
Right. And non-refundable just reduces your tax bill, but only to zero. That difference is the core metric for the true value of any credit.
And this leaves us with our final provocative thought for you. We noted that the Child and Dependent Care Credit's maximum percentage is scheduled to jump to 50% in 2026. So this raises a highly strategic question for you, the planner. If you are expecting a large optional dependent care expense, like a major summer camp or specialized tutoring, should knowing about that future 50% rate influence your timing? Should you try to time that expense to maximize next year's benefit, even if it means delaying spending this year? Something for you to mull over on your own.